Welcome back to another episode of Coffee with Coker. I'm your host, Mark Reiboldt, and this episode is talking about understanding private equity deals in the healthcare industry. So we're actually joined by Coker's CEO, Max Reiboldt, and Max and I talk as he and I both work in a lot of transactions and working with clients, whether they're hospitals or they're physician-owned groups. Trend that has really become popular over the years, but particularly in recent years now, particularly with physician practices, are private equity transactions. And so we spent a little time talking about this. Again, he and I have some firsthand experience engaging on these deals and working through some of the nuances of them. And there are some newly developed or kind of new emerging models to a certain extent where the nature, the structure, the valuations, everything associated with these deals with private equity buyers is they're continuously evolving. And so we talked through that a little bit. We talked a little bit about the background, how private equity deals have evolved in the healthcare industry specifically. And then we look at kind of some of the characteristics of the transactions that typically involve private equity. And when we talk about the different players that can be involved. And so it's, in the past, it's historically been very much a transaction between a seller, which is typically a physician-owned entity of some sort, whether it's a practice or a surgery center or something else. And the buyer, who's the private equity firm or private equity backed company. But now we're seeing some variation in that where hospitals are getting involved in some of these transactions, and some hospitals are even pursuing some similar models that private equity firms have traditionally sought. So it's a very interesting discussion. And it's a really unique kind of current status of these types of transactions in the marketplace, which is why we wanted to spend a little time talking about it. We'll also have some other information. We have kind of a short white paper that's been done on the topic, talking about structure and valuations, some of the other dynamics, and then also some presentations that are upcoming in the near future. So we hope you enjoy this conversation with Max and I. We always want to remind listeners, if you have questions, please feel free to reach out to us. You can find us on social media at Coker Group. You can also email us directly, feedback@cokergroup.com. And then, of course, you can find this episode and every one of our other previous episodes at coffeewithcoker.com, or you can also find them at cokergroup.com. Again, we appreciate you listening, and we hope you enjoy this conversation with Max Reiboldt. So welcome back to another episode. And as we mentioned in the intro, I'm talking with Coker CEO Max Reiboldt, and he and I are going to talk about private equity deals in the healthcare industry. And as I mentioned, really, this isn't necessarily a new trend, but there's some newer activity and models that are starting to emerge that we're seeing in different transactions. And as we're seeing it more and more, and some of these unique structures and different characteristics of the deals today, we thought it was relevant to talk about, because I know this is something, as we're working with groups, particularly physician entities, this is something that is on the radar of many physician groups as far as considering a transaction. And by the same token, it's now, I think, more and more on the radar of hospitals as well, because as private equity firms have come into different markets, it has changed the local market dynamic to a certain extent as these deals are getting done. And so it's something that's now, I think, on the radar of hospitals, or certainly should be. So I guess maybe, as we kick this off, maybe talk a little bit about when we say private equity. That's kind of a broad term. But do you want to maybe just talk a little bit about what does that mean in the context of what we're talking about today, so we can maybe narrow that down a little bit?
Sure, it's good to be with you on this podcast session, Mark. And sure, private equity, I guess, could take on various meanings. By its mere two-word name, it obviously is entities that are for profit They are private in the sense that they are not typically aligned with a health system or a not-for-profit entity that we find pervasive in a good way in healthcare. They typically are backed by investor money. And it could be a private aggregation of funding, or it could be, and often is that, or certainly it could be more of a true corporate type entity that is in the business of financing healthcare deals. So it really runs the gamut of investors, but I think that's the key point. It is equity money. It's typically not debt, although a lot of the deals, I'm sure the money that's backing them is sourced through certain debt, but it's really focused on a private entity group that is looking to obtain a return. And the good old American capitalistic way where you invest and you extend some risk. You might exert some management oversight, maybe not, depends on the structure. And ultimately you expect a return. And that return not only comes in the form of the year-to-year profit distributions, but hopefully in the accretive value of the investment through growth and expansion, and therein it could be realized that being that return on the sale. So private equity is a relatively new industry in healthcare, not new in other sectors by any means, and I think we're going to probably touch on that as we get into more discussion today, but I'll just leave it at that for the moment.
No, I think that's helpful, and you hit on a couple of things. I think they're the main points. One is this is a financial investment, which is unique to healthcare in that it's very different from the very traditional provider model, where it is about the community impact. I mean, look, healthcare, as I always say, is a local business, right? Healthcare delivery is a local business. This kind of changes that a little bit, and that it brings another dynamic because even though it is a local business, healthcare in the past, healthcare organizations, provider organizations have been able to generate significant returns, whatever that means, but significant financial growth, however you want to define that. But I think the other thing, just to point out, is when we talk about private equity, sometimes, and again, you touched on this, but sometimes I think the terminology is confusing. But there is the private equity fund. These are the guys that aggregate capital. They have institutional capital investors from all over the globe. Usually, there may be billions and billions of dollars in a fund. If some funds may be $100 million, some funds are even less than that. But usually we're talking about aggregated institutional capital that's deployed into different sectors. It's deployed via their investments. And usually those investments start in a sector or subsector through what we call a platform company. Platform company is the company that's developed or acquired initially to launch into a particular sector or subsector. And so we may talk about private equity, but some private equity is, again, the actual investors, the fund, the institutional capital. Some private equity is the company that's backed by the institutional investors. But it all is kind of the same or similar model, and it's certainly all connected. And so I think that's important to note. Now, I think also it'd be helpful just to briefly touch on some of the trends that we're seeing, how these deals, how the introduction and the growth of private equity within the healthcare industry is looking, and how it's kind of growing and impacting the marketplace. And I thought it was really interesting. There was a recent article from Modern Healthcare published in April, and it talked about this. It was, if we'll make sure there's a link available for the article in the show notes, but it was called Private Equity Infuses Healthcare with $63 billion Investment. And I thought this was interesting. And so just a couple of takeaways straight from the article that I thought were interesting. Right off the bat, it said global private equity-backed healthcare deals rose almost 50% to $63.1 billion in 2018, which was the highest level since 2006. And so pre-credit crunch, pre-recession, we're back up to those historical levels. And I think also very consistent with what we've seen, and it was that the fact that the provider sector was the most active as in these deals. Also, they said in the article, provider deals have led the investment domestically with 84 transactions in 2018 worth over $23.2 billion, which is the vast majority of healthcare private equity deals in the U.S. And they said behavioral and retail health, physician groups, and home care drew strong interest, according to the report cited in this article. So again, those are a couple things taken straight from this article that I thought was interesting. It's very consistent with what we've seen, but honing in real quick, when we talk about these, we've seen private equity in health IT over the years. We've seen private equity certainly in the kind of life sciences component of healthcare, biopharma, biotech, medical devices. That's nothing new. I think one of the more interesting things is the provider groups or physician groups, that the interest there, and what I kind of refer to broadly as allied health or alternate site types of care services. Home care is one of those. So I don't know, any other thoughts as far as either that or anything else that came out of this article that you think is interesting as far as the big picture, how private equity is playing into the marketplace?
Yeah, I'll just add a thought or two to what you said. I thought the article was well done and very factual and very relevant, needless to say. I believe that for whatever reason, private equity is of interest to provider groups. And you made that point, Mark, and I think it's a good one, that seemingly there's always been a lot of other healthcare-related transactions relative to pharma, IT, et cetera. But over the last year or two, those provider group deals with private equity have become much more prominent. The question begs why. I believe that one of the reasons is physician groups have gotten large enough in many places where, and it does take some critical mass of size, I think, to interest private equity entities. But I think they've grown to a point in many places where they really provide a paradigm that the private equity firms are looking for in terms of volume, growth potential, prospective ROI, et cetera. And that is not to say that those groups, the same groups that have hospital relationships, maybe even some integrated deals with hospitals, who knows, maybe even some PSA deals would no longer be of interest or a possibility. But I think private equity deals to these groups simply offer a valid alternative. And we probably will need to drill down more on that here as we continue our podcast today. But I in no way, shape, or form am saying that provider groups and hospitals should no longer work together or look to align or integrate. I actually think there are structures where you could do both. But on the other hand, aligning with a private equity firm doesn't necessarily mean that the group is abandoning its relationship with the hospital or hospitals in its community. Far from it. It's just another alternative relative to partnering. So let me stop there, but I think the discussion point that we want to drill down more on is this whole paradigm shift for provider groups and private equity funds doing more and more deals. And frankly, I'll just say for the moment, I think we're far, far from reaching the apex of that. I think there's a lot more out there, and again, a lot more to be completed.
Yeah, no, I think that's exactly right. And we will come back to that, because ultimately what I want to highlight is
what do these deals look like for the different players, the different actors within the marketplace, and ultimately what drives them, or what's the value of doing these deals. But I think before we do that though, one of the interesting things, and you kind of alluded to this, is why private equity, why institutional investors are looking at healthcare services, provider services, more closely with more interest, and where they're looking. I think the interesting there, and they refer to this in this article, right? They said, in fact, I'll just read this quote here. It says, there is a premium on organizations that are better equipped to handle new payment models. And I think that's very indicative of what we're seeing throughout the marketplace. That isn't just unique to private equity investors or for-profit investors. This is something that I think is going to impact hospitals. Hospitals are interested in those groups that have higher quality, good contracts, reimbursement models, good payer mix, but also are able to scale and expand the health systems or the hospitals' local marketplace and potential for growth there. But new payment models are key, right? And not every group is equipped, not every specialty is prime for some of these new payer models. And we've talked about that on other podcasts. So when we talk about new payment models, that can mean more the value-based care models, the quality-based measures, MACRA, and things like some of the new trends going on in reimbursement, things like that, I think are going to continue to drive transaction activity globally or throughout the system. And I think that's interesting here in terms of what the investors are looking for. One of the other dynamics, I think, one of the final comments in this article was, and again, I'm just going to read it straight from the piece from Modern Healthcare, but the need for private equity firms to achieve high returns, often at least 2.5 times over a relatively short period of time, may conflict with the need for investments in quality and safety and push for less utilization. I think, and that is a comment actually that was from the Modern Healthcare article, but that was actually from a report that was published by I think the Journal of the American Medical Association. But again, we'll make sure that that's cited there in the show notes. But I think that is one of the interesting things about when we talk about private equity, when we talk about kind of the traditional, I'm using air quotes here, ROI for healthcare deals where hospitals and physicians do joint ventures and different types of transactions, the returns that are measured are sometimes different than just your standard ROI or internal rate of return or whatever it is, what measure you're looking for financial returns that a capital investor looks for. And I think this is going to be one of the more interesting things that we watch play out with these private equity deals. Because if you're talking about a firm that's going in and looking to do a deal, maximize the value from that deal in the shortest amount of time, that may mean a lot of different things. And I think we can't ignore that. And by no means is this a negative slant towards or against private equity. But I think that's one of the things you have to consider. If you're talking about doing a deal with a partner or sponsor that's, yes, they're writing a big check up front, but what's going to happen 3, 4, 5, 6, 7 years after that deal is done? And what are they going to have to change in order to maximize those returns? That can be very different from what a health system or hospital offers. Any thoughts there?
It's definitely adding a new feature to the equation. And private equity funds are, as you say, and understandably so, they're for-profit entities, are looking for an acceptable return on investment for their investors, not unlike what you would see on the open market, public companies and so forth in that regard. And they're looking for ultimately some return on the ability to sell the business at some point in the future. So there are a lot of pressures involved in private equity structures, and I think it's interesting that at least in some of the deals that our firm, Coker Group, has been exposed to on both sides of the fence, working for some private equity investors is more so even on the provider side and other healthcare delivery entity side, as it were. I think the common thread is that the private equity funds are only looking for kind of the creme de la creme of provider groups and related entities. They're really not interested in problematic turnaround type structures, understandably. As a result, they're looking for strong management in place. They don't typically, start to turnaround management and put their own leadership in. They're looking for some level of expertise in reimbursement and compliance, for sure, within that group. And so when you put it all together, I think that the private equity firms are going to sift, at least in their minds, the cream off the top of the milk carton, as it were, and really go for those entities first. Now, with that said, I think that clearly there's going to be some mistakes made, and probably already have, and there's some disappointed investors at times. But overall, I think that the private equity investor is pretty savvy, pretty resourceful, and what will really, in my mind, prove to be, in addition to making a good decision on the front side on all these areas that I just noted, I think the ultimate determinant of a private equity deal's success will be more so in the arena of growth and expansion post-transaction. In the 3, 4, 5, maybe longer number of years after the transaction, and how that beginning corpus of entity can be grown and expanded. Therein lies some of the challenges for the industry, and specifically more so, in my view, for health systems. Because the way private equity groups that align with provider groups are going to grow and expand is through some element, in my view, of competitive threat to health systems, through surgery centers, imaging centers, ancillary entities as such. Now, there are solutions to that. There's three-way deals where health systems can be included if they're amenable to such, and so forth. But clearly, this is somewhat new turf that's being traveled, and I think a lot less is left to be answered in terms of the questions that are yet unanswered on some of the deals that have already been done. And so I think clearly we're going to have to monitor this, and folks like us that provide advisory services to all these entities, obviously not at the same time, are going to have to be very judicious. And frankly, all that I just said, I didn't even hardly touch on a lot of the details, and I didn't comment any on the compliance side, which is also a major part of this.
Well, I do, and I'm bouncing around. I even jumped ahead there. I'm kind of looking ahead to some of the dynamics, but I thought it was something I want to make sure we touched on. Because sometimes all we do, it's easy just to see the dollar signs on the front end of a process or an initial offer, but we have to consider more than that. And I want to come back to the specifically talking about the different players and stakeholders involved, and then even dive into some of the models as well that we're seeing. But we've done work with physician practice groups or physician services deals. Representing that side. We've worked with the hospitals that are involved in a wide range of transactions, and we've worked with the private equity firms that are doing these deals. And I think, we can speak to all those different perspectives, but maybe, I'd like to hone in on the physician group side because I think that's particularly relevant here. I know a lot of our listeners kind of representing that dynamic, and as well as we'll talk about the hospital kind of perspective as well of this. But before we talk specifically about the perspective of the physician practice in terms of the seller to a private equity in a private equity transaction, let's play a little game real quick. And we'll just go back and forth to say all the different specialties that we've seen engage in some sort of private equity deal or private equity-like deal in the past few years. And we'll just go back and forth until we've covered all of those different specialties. So I'll start off and say women's health or OB/GYN.
Urology.
Dermatology.
Ophthalmology.
Urgent care.
Plastics.
Orthopedics.
Spine, which is part of ortho, but I'll go on to say neurosurgery.
GI.
I think, interestingly enough, there's been, the next one I'll say is vascular surgery because we did a deal with vascular.
I know I've seen at least one cardiology related.
Mm-hmm. I was going to say primary care. Usually it is some sort of aggregation of family practice, internal medicine, and some subspecialties. But let's just say primary care for the moment.
Yeah. Anesthesiology.
Pediatrics.
I'm having to think harder.
I'll throw another one out. Geriatrics and palliative care. As the assisted living and age of our population is getting older, I think we'll see more of those.
Yeah, I'll add, and this is kind of a spinoff or a little bit unique, but specialty hospitals and one-off deals or ASC deals that are attached to probably one of those specialties we already mentioned.
Micro hospitals, I think, is a little bit akin to what you were just referring to. We're seeing more and more of those and transactions involving them. Freestanding EDs in some states, with CON regs allowing, you'll see more of that.
Imaging,
for sure. Radiology, hospital-based practices, specialties like anesthesiology, a number of them, pathology.
I think even in a little bit of oncology now. I mean, even though that's so heavily oriented towards hospitals, traditionally.
Yeah, there's definitely interest there.
Nephrology, renal care.
Dialysis. Another one that I was thinking about, it's a little bit off the subject of a specialty, but we're actually experiencing more and more interest in what I think is the term is used, blue zone, where we really have these zones of higher standard of living, wellness, and really trying to create this classification of quality of life that has the utmost of healthcare proactivity in terms of wellness and health maintenance. And adjunct to that, we're actually working on a couple of transactions that involve real estate developers that are really trying to develop these blue zone type structures, if you will. And so, again, often led by for-profit.
Yeah, and I think that's a great example of you're seeing these types of investors drive new models even of delivery that traditionally haven't been seen or haven't been found as widely in the traditional kind of acute care setting. And I think you could tie that to things like home care, home health,
hospice.
Yeah, hospice. Yeah, sure. Certainly long-term care. And but I think the interesting thing there is that what that exercise just showed is that it almost covers all different specialties, certainly different spectrums of health, and whether it's a surgical specialty or more of an internal medicine, primary care, or everything in between. So I think that's an interesting dynamic.
And one other that, again, it's not really a specialty per se. Although I was thinking one other specialty I don't think we mentioned, I'll say behavioral health as well. But where I was going a moment ago is with telemedicine. And again, not any particular specialty, but I think we're seeing more and more investors interested in the delivery of a telemedicine. Just let me give you a quick example. Obviously can't name names here, but we're working with a startup company recently in doing some of their planning, and the actual business model is addiction treatment, which, by the way, is a boarded specialty, addiction treatment centered care through telemedicine. So there you go. And it's a for-profit entity, not backed at this juncture by private equity, but certainly could be down the road.
Well, I think telemedicine is a great point because it covers many different specialties and modalities of care delivery, and the technology is there. And I think when you have savvy investors with deep pockets looking for downstream return opportunity, that's going to be an obvious target. I think that's absolutely interesting.
And I think an important takeaway from this little exercise we just went through, Mark, at least for me, is that there are specialties that have kind of been out of the zone of interest of health systems. Let me give you a couple examples. Dermatology is not typically one that health systems will have unless it relates to their cancer care sector. Another might be ophthalmology. Well, those have always been of great interest and still are to private equity. But the interesting point I'm making is that all these other specialties, GI, urology, et cetera, they're now under the radar, orthopedics, of private equity. It's not just these specialties that, let's just say at one time, hospitals were not particularly interested in, and they naturally gravitated to private equity as a result. That's no longer the case.
Which is also kind of going back to my earlier point, shaken up a lot of the local markets, because as private equity capital comes into some of these markets, then the hospitals do say, well, okay, maybe we do need to think about doing more deals in ophthalmology or even dermatology, or there's some partnership opportunities there, and kind of shakes it up a little
bit.
Right,
absolutely. And creates a whole new paradigm of strategy for health systems.
Yeah, that's right. Well, let's look at this from the perspective of the physician group. And I think what we can also say, kind of dovetailing from that little exercise, is that we're not just talking about private equity coming in and doing deals with the, super groups, quote unquote, right? This isn't just, 100 physician groups that they're looking at. Obviously, those are, I think, probably, well, I don't know if you say they even are the priority. Those maybe get the most attention because they're certainly bigger in terms of value and size as far as that goes. But, I've seen deals with private equity with 4 physician ophthalmology groups, or 12 doc surgery general surgery practices, 4 physician neurosurgery pain management docs, and we're talking big dollars too. I mean, there was a deal here in the Southeast in the last 2 years that was over $60 million with private equity that was in neurology, neurosurgery, and pain management. And there was only maybe, I think, 6 physicians actually involved in that group. And I'm not saying that type, you can extrapolate that valuation to all those types of groups. This was just the nature of this one deal. But my point is, all sizes, essentially all specialties, all models, I think are of interest. But if we're looking at this from the physician practice perspective, what are some of the things that you would say if you're talking to a physician group and they're saying, we're having private equity firms start knocking on our door a little bit more, asking if we're interested in doing a deal? What are some of the things you're going to tell them, just kind of to basic information to think about?
Yeah, it's a great question, and we can explore it probably a lot longer than we have time. But I'll try to touch on a couple of things that are of note. First of all, there's no real magic bullet here that a private equity firm can deliver to a physician group vis-a-vis creating upfront value over and above their hard assets, their tangible assets, which are typically, very small total amounts, because most practices are not capital intensive. And by the way, most of the time are not included within any real estate. That's usually separate. So with that said, then how do you create value up front? Because that's typically what's of interest. Health systems don't do that today. They could emulate a private equity deal by simply doing what the private equity folks do, and that is for the physician the modeling of the historical structure and the prospective post-transaction structure to be such that the physician, let's just say partner, for the most part, it could be all physicians, all providers, for that matter, I suppose, mostly physicians though, their compensation would go down post-transaction. So that creates an EBITDA near term, which is able then to be capitalized, discounted back to present value, et cetera, that excess earnings, and create upfront value. The trade-off, of course, is what we call often in the industry and in the advisory services that we perform, the haircut, which means how much reduction do the physicians take in compensation, because that's what generated the upfront money. And so there's really no, like I said, no magic wand here. That's the way it works. Now, the compelling part here for groups, to answer your question, Mark, is for them to, A, realize there is upfront money, and so they get it upfront. B, that they'll probably take a reduction in compensation for a period of time, maybe a long time. And C, the only way to make up that differential, that gap, is through growth and expansion and an improved bottom line. And that's hard. That's not an easy task. So it really, private equity deals will appeal to some. I'm often asked, well, who does it appeal to the most? Not surprisingly, it appeals to the physician who has 5 or less years left to practice, because they're going to be gone, retired, and they'll enjoy some of the upfront value that they got that these days are not usually structured in buy-sell agreements of private groups. So, because usually it's just easy in, easy out these days for private groups. In other words, they don't pay much in to be a partner, and they don't get much when they leave. This gives them more of that. And so I think that's probably the single greatest characteristic of private equity deals that we have to make sure we've explained well. And again, I'll just reiterate one other point, then I'll throw it back if you want to add some more comments. But to this point, the explanation to the physicians is such where they have to understand that it is nice upfront money, but they now have a partner. They may not have sold 100% of their business. That could be a plus or a minus. And they're going to have to make up the difference in the lost income, which they may or may not be at a stage of their life and career to incur or accept through growth and expansion, which is easier said than done. So I don't want to sound negative to private equity, but that's the reality.
Yeah, and I think you have to look at all the different elements here, and anybody I think that was sitting around the table in these transactions would have to agree. I want to take a step back and go through something that you went through, dig into a little bit more, and make sure we explain. So one of the things you're talking about is if you look at kind of the standard physician practice, right, there's no real what we call earnings or EBITDA. And if someone's listening that's not as familiar with what we're talking about, EBITDA is earnings before interest, taxes, depreciation, and amortization, basically ties to the enterprise value of that entity. The earnings. That in a traditional physician practice is very minimal, because the earnings are what go to the physicians as compensation traditionally, right? And so in order for there to, and that's why you see when hospitals typically come in and purchase a practice, they're basically paying for tangible assets, because there's no real goodwill or earnings there's no earnings that translate into true goodwill, intangible value. Okay, so that's kind of the standard or traditional model. In the private equity model, they're essentially coming in and saying, we will create earnings. We'll manufacture EBITDA legitimately, not just on paper, but they go through kind of an analytical exercise, and that's what you described. They say, in order to create earnings, we have to take back some of that compensation over a period of time. So let's say your group generates $100 million in revenue, and 30 million of that is physician compensation. In order to create true EBITDA off of that $30 million, we're going to reduce that by, let's say, $5 million. And if you have $5 million year over year, at some point, those earnings are very attractive. Those are good earnings. But it has to be over a period of time. And as you said, it may be a long time, it may be permanent, maybe forever. But the idea is that it essentially boils down to upfront, more value upfront, as opposed to less value over a period of time. Whereas you do a traditional deal, you're getting very little of upfront, but you're getting essentially more down the road in compensation. So there are all kinds of dynamics there if you want to get into a kind of a financial analytical exercise. Not that we need to do that, but I think it does set the tone a little bit because, as you said, that can be very attractive to a physician that is perhaps later in their career. They're to a point, they've paid off all their loans. They've generated built up good income over time. And so they're to a point where they can deal with less income for a few years while taking that money up front, go ahead and start thinking about a succession type event, transitioning into retirement. And the year over year income is not nearly as important. There are also tax variables here too, right? If you're taking a significant chunk of dollars and that translate from long-term capital gains, that's taxed very differently than ordinary income. And so there's some appeal there. But I think, what you covered is exactly right. I think the conversation with the physicians typically starts at, what are your priorities? Do you want to maximize the amount of money you can get today or upfront when the deal is closed? Or is that less appealing and you would rather have, sustainable, secure income year over year for the next number of years and kind of grow it slower?
There's a couple of other, let's just say, factors at play in the decision-making process of the physician group. In some cases, they're looking for a management partner. Now, again, I said earlier, oftentimes that PE firms are looking for well-managed practices. So it's kind of a conundrum of sorts, but the physicians, at least from their role of managing, are frustrated by reimbursement, managed care, etc. And so I think that's a factor, however intangible it might be. I think another factor, and I want to be very careful how I say this, health systems and larger groups work well together, and they should work well together post-transaction. But let's face it, there's still this issue of trust and how far do we go with our affiliation and alignment with health systems? And when they have an offer, an option, an alternative for private equity fund, that may well be a reason they would go with a fund as opposed to a health system. And last but not least is the fact that private groups realize the potential to grow ancillary services with private equity backed money more so than maybe they realize that health systems would do it. However, there are many health systems out there that have been extremely willing and cooperative and very proactive in including their physicians post-transaction in these deals. And so I would just simply say that if a health system is willing to partner with a group, and who knows, maybe even with a private equity fund as well, that has affiliated with a group, then I think there's opportunities for everyone to have a piece of these ancillary investments.
Yeah, no, I think that's exactly right. The dynamic does not have to be either or, I guess. We said that earlier. Meaning it doesn't have to, just because you do a deal with private equity doesn't exclude you from having to work with the hospital and vice versa. And we've seen that. We've seen deals, groups that have done deals with hospitals and in some areas, and then they've sold other elements of their group to private equity, and that's pretty common. the other thing, and again, we talked about this earlier, I think you have to understand is if you are the physician practice looking at these deals, as you said, your partner, you have a new partner, you have a new owner. You're no longer, if you've been a partner for 20, 30 years maybe in your group and you've built up this group, once you sell it, you're no longer a sole equity owning partner. And so I think that can change the dynamic a little bit because, again, as we alluded to earlier, what is that private equity firm ultimately going to do with that group? And this is not their fault, and does not have to be a negative thing, but they may sell you they may sell your group in 4 or 5 years. And that's another transition. That's a liquidity event for them. They may end up being out of the picture entirely, but then you're working with a new owner. And I think there, again, it kind of goes back to not every group is made up of physicians and providers that are in kind of the latter stages of their career, right? It's particularly your larger groups. You have a group of 50 doctors or 100 doctors or whatever it may be. You're going to have a mixture, right? You're going to have some people that are still early on in their career. Maybe they're new partners. Maybe they're not even partners yet. You have others that have been, doing it for 30, 35 years and all ready to kind of think about succession and transitioning into retirement and get the value out sooner rather than waiting downstream. So those are dynamics you're going to have to manage within the group. And before you get that deal done, if that's the route you want to go. Let's talk real quick before we close out about the hospitals, because I want to make sure people realize that this isn't just about the private equity investor or buyer and the physician practice seller, because the hospitals do have, I think, more of a dynamic interest here than probably most people realize. And we're starting to see that more and more. Again, we talked about earlier how some of these deals can shake up a local market, and that may attract the interest of the local hospitals. But, we're also seeing hospitals having to respond a little bit more, a way that's more innovative than traditionally speaking. Meaning, is there a way that a hospital can do kind of a private equity-like model? And I'm teeing that up for you. You can talk about what we've kind of seen there that's evolved in this private equity-like model. But I mentioned in the intro that we also just did a short white paper on this model, private equity-like model for hospital physician transactions. So again, we'll make sure that's available in the show notes. But maybe talk about that a little bit from a hospital perspective.
Yeah, and I think the big takeaway first, I'll say, Mark, is that hospitals don't need to be looked at as stepchildren when it comes to this equation. They're still a vital part of the equation in our view, and they have a role in partnering with these physician groups and other entities, and potentially, who knows, even with some private equity. As far as that goes, there are some private equity entities that own hospitals, so go there. The private equity-like group model that you alluded to is really pretty simple in comparison to what we just said. It equates quite comparably to a private equity deal. And so essentially what a hospital will do, and usually requires a pretty good sized group to accommodate such a structure. But if the group is looking for various reasons, a legitimate amount of upfront money, more than just the tangible asset value, their assets alone, their hard assets alone, the simple way to create that is the same way that private equity firms do, and that is to model and then make sure in reality this really happens post-transaction, a reduction in what is typically partner physician compensation. And as a result, that creates excess earnings, which is appropriate to capitalize, discount back to current day money and present value, and pay an upfront amount. The reduction in compensation is negotiable. It may be more, it may be less than a private equity deal. It may be for a shorter period, but even if it is a shorter period, that would have to be factored in to the discounted cash flow income approach of valuing the business, which is very easy to do. So at that point, we have compared favorably with a private equity deal. Many health systems are not particularly enamored with paying upfront money to any physician group. That may in and of itself create some obstacle on the part of the hospital. And typically this may be only structured under the auspices of a group that, let's just say, truly has an alternative to sell to a private equity fund, and the hospital is interested in meeting similar objectives of the group. And the kind of the devil in the details is the situation here. If you ask me, well, what's the relationship post-transaction? Well, it's employment. So the doctors are employed, and typically there could be some ancillaries. There could be an MSO. There could be an ASC. Maybe the group doesn't sell 100% of those ancillary entities. So it can keep a stake under appropriate compliance and regulatory parameters in some entity post-transaction that is a true equity partnering arrangement, and that can mitigate some of the concerns that the group might have. Well, I can't participate in ancillaries once I become employed. They could under that basis. So in our view, it's not for everybody. It's not for every group. It's not for every hospital. Obviously, it's more upfront money. Some hospitals may not have those kinds of monies at their disposal or the ability to borrow and get a return, so it may not make sense. But from our view, if you do have a private equity deal, and I'm talking now since we're on the subject of health systems and hospitals and their strategy, if you do have a group that says, look, I've got $50 million, I made that up front, and we've got all this other structure in the deal, how are you going to match that? Well, the only way to match it is to create a bottom line, just like they do, private equity does, and then figure out kind of how the structure would be post-transaction. And at that point, you can be competitive and go from there. So, again, I just want to quickly say it's not for everybody. There may be some tax issues involved. We don't have time to go into those. Who knows if you can obtain capital gains and reduced rates as a result. On the physician side, from a transaction like this, it would require a lot of analysis and both CPA and tax attorney advice to sort through.
Well, I think speaking from the perspective of that you and I are speaking from of an advisor as well as a firm that has rendered opinions on valuations for, that's been a key thing that we've done for decades now, literally, in healthcare transactions, is, you can justify doing what we're talking about from a hospital's perspective. This is real value that's being created, and it is something that I think can be still very much within compliance boundaries as far as fair market value and those the regulatory requirements that come with such deals. But there has to also be an understanding. I think it's probably unlikely that a hospital, let's say again, we're a physician group, we're considering an offer to sell to a private equity firm or the local hospital that we do work with already. How do you look at those side by side? The numbers that you compare, the bottom line, this is what we're getting for doing the deal, probably are not going to be matched. Meaning it's probably going to be higher with a private equity firm. I mean, yeah, I guess there's obviously potential for exceptions there, but in general, I think it's safe to assume hospital's not going to be able to completely match that. But what can they do? Well, I think they can. There are both quantitative and qualitative components to that. On the quantitative side, maybe they can't offer as much upfront value, but maybe that reduction in compensation, that haircut that we talked about earlier that creates earnings, maybe that doesn't have to be a permanent haircut. Maybe they could take that reduction in income, they being the physicians, for only a certain amount of time, maybe a few years, and then it's restored or it goes back up to market rates, something like that. So that that may balance out a little bit more in a more appealing way for those groups that, it's not just all older physicians that are kind of towards the end of their career, but it makes sense for those that still have 20 years of their career in their practice left. That's not always the case, but I think that's one thing, because again, a hospital looks at returns differently. They get the value from the deal differently. They don't necessarily need to think about a 5-year horizon to flip the investment and have a liquidity event. And I think that ties to another qualitative variable there, in that, when you're looking, comparing partners or potential partners, what is the dynamic going to be working with a for-profit private equity-backed entity versus the hospital that maybe really well, you're in the same market already, you've done business for many years, maybe you have other arrangements with. And again, that's not to discount the value that private equity can bring. It's just about what are your priorities, right? And we talked about this in the white paper. There's no right or wrong, answer or recommendation to apply to this broadly. It really is case by case, and it's about what the priorities of the group, what those priorities are.
I think that's well said, and I do think that we should give some brief discussion relative to I think most physician groups that we work with and have now for over 30 years in our firm, and hospitals, really want to work together and truly support the premise of improving the quality of life through the healthcare services they provide to the community. And frankly, I think that applies to for-profit hospitals or not-for-profit. I think they all feel that is their mission. And I don't want to sound naive here, because I know bottom line and economic return is important, but I just believe that most groups want to see and should see their hospital be successful, or hospitals in their community. And they want to work with them. And I think that's where some of these transactions will ultimately prevail, where groups will decide to, whatever they do or don't do with private equity, they'll still want to work with and should be a partner, and I use that word in quotes, with their health system. And I think if we can continue to kind of keep our eye on that ball and focus in that area, then I think whether it's a private equity deal that a group does or not, I think it really will preserve the quality of the healthcare system, which I still think is, with all of its flaws and all of its challenges right now in this country, is still among the very best.
Well, I think that's well said, and honestly, it probably is a good way to kind of bring it full circle. I think this is something that we're still, even though private equity has been deploying capital in the healthcare industry for years, what we're talking about, particularly in the physician services, provider services space, is still relatively new, and we're still very early on in this kind of new emerging dynamic where the hospitals are able to think of a little bit more innovative strategies for doing some of these deals and different types of partnership models with the physician groups within their market. So I think this is something we're still going to see. We're going to continue to see how it plays out. We're going to see, how a lot of these deals that have happened over time, over the last few years with private equity, are going to pan out, and we'll see the outcomes there. But I think it's something that I think is good for healthcare. I think it's driving competition. It's bringing value to the stakeholders. And ultimately, at the end of the day, I think we can also, and we didn't even talk about this, and this is a whole other discussion, but I think we'll be able to track, to a certain degree, some correlation with just improvement in quality of services, frankly. I think we've always argued there's a close correlation between value and quality of services. And I think you'll see that trend continue here. So definitely expect more discussion from us on this, more insights, and we'll be interested to see how some of the different cases play out, and hopefully you'll be able to comment on these in the future. But thanks for the initial thoughts, and we'll look forward to having further discussion soon.
I agree. Thank you.
We hope you enjoyed that episode of Coffee with Coker, and we thank you for listening. We want to encourage all of our listeners to participate and contribute in the podcast. So if you have any questions on any of the things we discussed in this episode, any of the topics that were presented, please feel free to ask us. Also, we welcome your feedback and suggestions. If you have any ideas related to the material we discussed in this episode, or in any episode, please let us know and we'll make sure to incorporate it. And if you have ideas for topics you'd like to hear more information about in future episodes, please send those suggestions to us. We would love to hear them, and we'd love to incorporate them into our future episodes. You can find us online and on social media. Start with our website, and specifically the podcast is coffeewithcoker.com. You can also find that through the main Coker website at cokergroup.com. You can also find us on social media, Twitter at Coker Group, and then on LinkedIn, you can search for Coker Group and find our page and the page for some of our team members as well there. So you can find us and reach out to us a number of places. And then if you want to contact us directly, one of the best ways to do that, email feedback@cokergroup.com. That's feedback@cokergroup.com. And again, we'd love to get your feedback, and we'd love to encourage everyone to subscribe to the podcast so that you can be notified when future episodes are released. We look forward to the next episode, and we look forward to getting your suggestions and feedback on this episode. Thanks for listening, and we look forward to speaking with you again on future episodes.